you'll be live soon.
Good morning, everybody. It's going to be a fun time. This is our first virtual summit, and we're really excited about it. I have our Chief Investment Officer, Jeff Porter, here with us, and he's going to share a lot of insights about what's going on in the investment world. Everybody should have received their little booklet to take notes. The good news is Jeff's going to have some slides he's going to share with you, so those will be available, but you might want to take some notes, and certainly there's a button on your screen that says Q&A, so if you have any questions, please post them there. We're hoping to have some time at the end of the session to be able to take some questions and hopefully answer everything that you have, but there's a lot going on right now. Let me get started by introducing Jeff. Probably most importantly, he's been with the firm for 17 years and been a major part of the company and the growth and serving clients. But even more important, he's got a wonderful family, married with 2 children, living in Arlington, Virginia. Went to UVA, got a finance degree, and smart as a whip. So you're gonna be enjoying this time. We've got about an hour together, and Jeff's gonna kind of get us going. So with that said, Jeff, let's just jump into it and tell me, any surprise to what you decided was the main theme and topic for today's session?
Not at all. Not at all. At the risk of being hyperbolic, I mean, low interest rates in the interest rate world, I mean, I believe this is the critical variable driving markets now and in the future. You know, it has been to an extent, but even more so right now. I think it is the critical conversation that investors should be having with themselves or their advisors, because, you know, not only do interest rates directly impact the bond market, but they impact every single other asset class out there. So, you know, it's important, and that's why I'm glad that we're rolling up our sleeves today. We're really going to dig into this topic, and I'm looking forward to it.
Yeah. So a low interest rate environment, we've been experiencing that for some time. Let's go into why it's so important.
Yeah. So you know that I love my charts and graphs. So let's start with an important one, which is the 10-year Treasury interest rate throughout history, what you would receive if you bought a 10-year Treasury bond. And you can see there in the early 80s, interest rates were up around 16%. And over the past 4 decades, they have been in a steady decline ever since. They got to around 0.5% last year. They're up around 1.3%, 1.4% now. But you see that that's lower than any time in history, even lower than the kind of 2-decade period, the 40s or the 50s back then, when you see things kind of flatlined around 2 or 2.5%. So, you know, Greg, this 4-decade downtrend is important because when you look at bonds and what you receive from bonds in returns, there's 2 things that you get. One is the interest rate that you get on an ongoing basis, and the other is the principal gain or loss. So if interest rates are going down, you have a gain, and vice versa. So, you know, in my discussions with clients and people over the years, you know, people outside our business have a little difficulty understanding that relationship. So let's give, you know, a quick example. So let's say the government issues a 10-year Treasury bond and they're paying a 4% interest rate. So I go out and buy that. The next day, something crazy happens. Interest rates plummet. The government issues a brand new 10-year Treasury bond for 2%, paying 2% interest rate. And Greg, you buy that one. So why would anybody want your bond at 2% versus my bond at 4%? It's practically the exact same thing. And the answer is they wouldn't. So the only way people are going to entice me to sell my bond is to give me a huge premium. And that's why if you own bonds and then interest rates go down, then prices go up. So it has really been kind of nirvana for bonds over the past 4 decades. And you see that in this next chart I'll show here, which is the index returns, annual returns by decades. So the index has thousands of different bonds, mostly government, a little bit of corporate, high quality corporates as well. So you can see in the 1980s, bonds were getting 12.43% annual returns. So that's fantastic. That's more than stocks have provided over the long term. In the 90s, 7.7%, 2000, 6.33%. And it was really only in this last decade where the low interest rates started to filter through into those returns. But kind of in sum, a great run for bond investors, over the past 4 decades.
Yeah, that's interesting. So you can look at that, the return, and the key is going to be certainly when we look at 2020 and you look at the next 10 years and you have the 10-year interest rate right now at around 1.3, 1.4%, you can see it's staying inside that trend, so that the next 10 years, we're not looking at very strong rates going forward.
Right.
The key, though, ends up being people use bonds as a ballast to their portfolio, right? They're not just looking at it for just they want to know that, when the stock market it happens to be trending down, that they have a safer asset. Talk about that for a little bit, because the ballast of a portfolio is pretty important.
Right. That's the other part of the equation. And you can see that pretty clearly here. This looks at the past 6 downturns for stocks. So right in the middle there, you see the MSCI World Return. So that is the stock market index, not only in the United States, but also international stocks. And you look at the average, what happened in these 6 downturns, stocks declined 34.2%. So then you look to one column to the right. Well, what happened to interest rates for 10-year treasuries? They went down by, on average, 1.2%. And then look to the far right, that generated, on average, a capital gain of 10.9%. So, for example, if you had 60% of your portfolio in stocks and it went down 34%, and you had 40% of your other money in bonds going up 11%, that really helps. That really helps. So, that is another good thing, not only great returns, but also that ballast in the portfolio, like you mentioned.
Yeah, and so people are looking for that. And of course, we know the ability to get to that higher returns gets harder and harder as interest rates come down, right? So when interest rates are at 4% and they fall to 2%, you have a significant capital gain. But if you're at 1.4% and it falls to 1%, not as much of a ballast for the portfolio as far as return.
Less juice. Yep.
Yeah. So when we're looking at interest rates, we know how it's now working in the portfolio, balanced out against the stocks. But what about other markets? I mean, how are we looking at that as far as other markets and the impact of low interest rates?
Yeah, and as I mentioned, it impacts everything. So let's talk through kind of how it does that, and let's talk about today's scenario. So before COVID, if you were in a savings account, a checking account, CDs, money markets, you were getting around 2% interest. So that was okay. That was nice. Then COVID hit. The Federal Reserve decreased interest rates all the way down to 0, and all those savers are now getting nothing. So what do? They say, man, is there any other interest rates, higher interest rates that I can get? And they go out the next step out the risk spectrum, which is to the bond universe, and the safest part of the bond universe, so treasuries. And let's say they see 2 to 3% in treasuries. Everybody rushes out and buys those treasuries. The prices go up. The interest rates go down to 0.5 or around 1%, where they are now. And then you have all these treasury investors being like, 1% on a 10-year treasury? What else is out there? Well, I can take a little more risk in corporate bonds. I see these corporate bonds out there paying 3.5%. Everybody runs out and buys those. Corporate bonds goes down. The interest rates are around 2%. That's kind of what we're seeing right now. So now corporate bond investors are saying 2%. I'm taking on some risk. If inflation is 2%, my interest rate is not even surpassing inflation. Well, I'm going to go buy junk bonds. And then the same thing happens. And oh, well, I'm going to go buy stocks. So this is kind of how it cascades through the various asset classes. And because stocks, people like to talk about, stocks, obviously, I can show this relationship with this chart here that shows in red the interest rate, the 10-year treasury rate that we were looking at, a couple of slides ago. But in blue there, that's the price earnings ratio of the S&P 500. More specifically, it's the cyclically adjusted price earnings ratio. So it takes the price of the S&P, it divides it by the past 10-year average of earnings. And what you can see throughout history, most every kind of segment throughout history, as interest rates go down, or let's say take the opposite, as interest rates go up, price earnings ratios tend to come down. And when interest rates go down, price earnings ratios tend to go up. So let's take a look at this most recent 40-year period that we're talking about. In the early 80s, you had interest rates, again, at near 16%. And then they have gone down ever since. So in the early 80s, look at where the blue line was. People were paying a PE ratio for stocks of roughly around 6. So now you see that's all the way up to 33.7, more expensive than pretty much any time in history besides the tech bubble. So what that means is that stock investors are now paying 5 to 6 times the amount for earnings that they were 40 years ago. And a big reason for that is because of interest rates.
Yeah, and so that's a little complicated probably for the average investor. I mean, it's a good technical chart, but in essence, what you're saying is as interest rates fall, we pay more for asset prices such as stocks, which is what you're showing there, 5 times more than we would have under other circumstances.
Yeah, hey, I'm not getting much over here. I'm okay with paying out the nose over here.
Right, and so we start paying higher amounts for higher yielding instruments, and we pay higher amounts for stocks that are paying higher dividends. So it kind of pushes those prices
higher
up.
Potential returns. Exactly.
Yeah.
Yep.
So sounds like it's where the person says, let's just put all my money in AT&T and get a 6% yield, assuming that that's going to be their rate of return.
Right. Yep.
Yeah, that becomes fun. So what about the risk side? I mean, you have this combination going on between the stocks and the bonds, because that's where most people's portfolios are, between their allocation to stocks, allocation bonds. What's the overall risk equation that we should be thinking about?
Yeah, I mean, the next question comes, okay, we're in this low interest rate environment. The world has changed more so than it ever has. What's the impact now? So
Right.
If you look at what the impact is on the kind of the ballast of the portfolio that you were mentioning before, probably the best way to analyze that is looking at what most recently happened in COVID to bonds, not only the United States, but also all around the globe. So if we look at what happened most recently, this chart shows in blue the starting short-term interest rate. So where short-term interest rates were prior to COVID. And then in gold, the COVID downturn happens. So what were the total returns for the 10-year treasury bond? So that's what this looks like. So let's just take the US for an example. Before COVID, short-term interest rates were at 1.75%. The COVID downturn happens, interest rates go down. What did the 10-year treasury note or bill bond for the United States return? 8%. So it's not that 11% that we saw earlier, but it's still pretty darn good. 8% is still pretty darn good.
Yeah, most investors will take 8%.
Yeah.
Yeah.
The problem is, look at other countries as you kind of go down this list here. The lower the interest rate, the lower starting interest rate, the less oomph you got from bonds. And then you look at Sweden, Japan, Germany, Switzerland, where they had negative interest rates going into COVID. They actually had a negative experience from bonds. So I think there's a little bit more juice left in the United States because we have 10-year Treasury at around 1.4%. You've got the 30-year bond yielding around a little over 2%. So if there was a downturn in the near term, I think those would likely go down close to zero. Who knows, maybe negative, and you'd still get that bump from bonds. But you can see, you can see how this impacts things. You can see where we're going, and it is kind of losing some of its bang as a ballast in your portfolio.
Yeah, and that's the key, because when there's the next stock market downturn, you're trying to say, well, how do I have some protection to the portfolio?
Right.
The bonds have been providing that. What you're showing, though, is as interest rates come down, they provide less and less ballast to the portfolio in that situation.
Right.
So
that doesn't mean you get rid of bonds. You know, when stocks go down, most of the time it's because of a recessionary, depressionary event, and those are largely because they are deflationary events. And in deflationary events, bonds still, are great ballast, but less so.
Well, that's the point. You're saying that the performance is going to be coming down in the bonds. So as the stocks have their challenging moments, you're not going to have as much of a support mechanism from the bonds, but still there. I mean, they're still going to be a lot better than you would be if you had 100% in the equities and you were worried about downside risk.
Oh, yeah.
Yeah. So how about the return perspective? Anything in particular there that we should be thinking about?
Yeah, it's all about expectations, right? What can people expect from their bond portion of their portfolio going forward? And there's really only three ways interest rates can go, as far as I know. Flat, they can go down, and they can go up. So remember that first chart I showed you in the 40s and 50s, how interest rates just kind of went flat. So what did people get? The interest rate. They just collected that. There was no principal gain, or loss. So let's pull up that same chart that I showed you before of the decade returns in the indexes. So take a look at the 40s and 50s. 1.83% annually for bonds in that decade. The 50s was 1.34%. So again, you just got the interest rate. And I kind of often say, you can't run away from this. You got to deal with this low interest rate at some point in time. Now you can hide for a little bit, but you can't run away. So let's talk about hiding from this situation. That's if interest rates go down. So 5 years ago, if you look at the international bond index, they were giving you similar interest rates as currently in the United States. Over the 5-year period, past 5 years, internationally, inflation wasn't strong. Interest rates ended up going down to zero, and in some countries, negative. And the international index returned 4% a year. So 4% a year, I mean, I would take 4% a year over the next 5 years in bonds. And the reason, again, is just because interest rates continued to go down. So that's one option. But at the end of 5 years, the international bonds are now offering you nothing in terms of interest rates. So let's say now interest rates just flatten for them. So essentially you get nothing over the next 5 years. So you got 4% for the first 5 years. You get 0% for the next 5 years. So you look over a 10-year period, I got around 2%. Oh, and by the way, interest rates are still at zero. So you can't run away from it. That's math, right?
Right.
So the other option is interest rates going up because of an inflationary concern, interest rates going up. So investors then should expect slightly negative returns, and nothing like stocks, but when they go bad, but slightly negative returns for bonds, potentially flat returns for a couple years. But then as interest rates go up, that starts to heal the situation, and then you start working your way out of it. But either way, any way you slice and dice this thing, you're in a 1 to 3% annual return type of world over the next 10 years for bonds. So you just gotta keep that in mind as investors and make choices accordingly.
Right. So going back to the ballast, it keeps the ballast to the portfolio, but your expectation for rates of return need to be readjusted compared to what we saw for the last 4 decades.
Yeah, in summary, it was awesome returns, awesome balanced. Now it's going to be a little less balanced, but less returns.
Right, right.
So that's the hand we've been dealt. What do we do about it?
Yeah. So before we get into exactly what we do about it and what the potential other alternatives are to investing, let's talk a little bit about inflation, right? Because that's the big issue that's starting to hit the news. Like, because of all the printing of money and the increase of money supply, et cetera, that we're looking at more of an inflationary environment.
Right.
Yes or no, and maybe or not. But obviously it has an impact on bonds, right? Because the Federal Reserve has to figure out how they're going to handle the change in interest rates via what's going on in inflation. So talk about that for a minute.
Yeah. So we haven't had inflation in a while. So some people are like, why are we worried about inflation? Why are we even talking about that? So this is the reason why people like us talk about inflation. So what this shows is large company US stocks, US bonds, and US cash, and how the returns have been in various inflationary environments. So in blue, there is what the returns have been if inflation is below the historic median of 3.37%. And then in gold, what have the returns been when inflation has been higher than 3.37%? So just look at US large company stocks. When inflation has been low, they've returned 13.68% annually. When inflation has been high, that drops off a cliff to 1.82%. You see kind of a similar drop off for US bonds and a drop off for cash. So that is the whole reason why we're even talking about inflation. Now, in terms of what our expectations are, I would say our base case is that inflation might be hot, running a little higher in the coming quarters because we're having this coming out party here around the world. There is still stimulus running through the veins of the economy, and there's essentially some constraints, I would say, some supply constraints because of COVID. But then after you get through this little spike, it's still going to be hard to generate meaningful inflation. And the reason is that the big structural issues that were containing inflation in the past 10, 20 years are still there. That is massive debt, that is poor demographics, and that is technology that is suppressing all these costs. And I like to show this chart. This chart is the chart of truth. You are looking at Japan, Europe, UK, and the United States. They all look similar. You have this rising line in all of those charts. That's the debt level, debt as a percentage of GDP. And then you have this declining line, it's kind of like mirror opposite here, of that is interest rates. So once you get up to a certain amount of debt, the more debt you tack on slows growth. It's a drag on growth, which then is a drag on inflation, which then is a drag on interest rates. So this is an example of a structural issue that makes inflation hard to take off. And this one we've made worse because last year we just blew out our deficit to the point where it was a higher deficit than the past 5 recessions combined. So this one has gotten worse. And this is kind of the reason why it still may be hard to generate inflation. Inflation certainly isn't a slam dunk.
Yeah, that's really what's important is, you're going to hear a lot of reports about inflation and, it has to happen. But, and therefore, what higher inflation is going to mean higher interest rates. But the point ends up being there's no certainty to that outcome. There's a lot of headwinds that come against how that inflation can actually come about.
Right.
So makes it a little trickier dealing with that.
Right.
So obviously, we're saying maybe things are a little bit different now, certainly than they have been in the last 40 years when we've had this massive interest rate decline. let's talk about what those differences are and maybe what we should be doing about it.
Yeah, so we just talked about kind of the big gorillas that may tamp down on inflation, but then there's kind of a piece next to it that says, yeah, but there's some differences.
Right.
And you have to start with this chart here, which shows money supply, M2. What the heck is that? So money supply is cash out there or things that can be quickly converted to cash. And you look at that moonshot there to the right, money supply is increasing at a 25% rate, which is more than any time in history. And the reason why this is a little bit of a concern is because you see in pink, that's inflation, that's CPI. And there's a connection there. You see, there's a correlation. So money supply spikes. Will we get inflation? That's a pretty big spike.
Yeah, explain a little bit where that money comes from, so that people understand how money supply, how does money get into the system? How do you have a spike like that? Just help people to make sure they understand that.
Right, because basically what you're saying also is, okay, we've got this spike up, it's at 25%. Well, there's been other spikes recently up to 10%. Look at the inflation rate there. Look at the inflation rate. It has essentially gone down a little bit. So why hasn't that produced itself? And I would say that it's important to know that M2, or money supply, I describe it as gasoline. So if you have a bunch of logs in front of you and you douse this thing with gasoline and even more, do you start a fire? No, there's no fire. You need a spark, you need a match to be thrown on it, and then the more gasoline is on there, the more fire, right? So how does money get created in our current system?
Right.
Money gets created in our current system by running through the commercial banks in the form of loans. And then, people borrowing those loans then go produce stuff and go spend stuff, and it starts circulating around the economy quicker. And then you start getting inflation. So the big question I get asked, same thing, is we haven't had inflation, even with money supply. What's going on there? Well, look at the global financial crisis in 2008. That was a crisis of the banking system, and that was a crisis for households. Banks had taken on all this debt, all these loans out there. So banks needed over the past 10 years to delever, pay down the loans. They weren't exactly eager to be like, here's some more loans, everyone. Households, remember the old, using your house as an ATM. That's what people were doing. They were taking out equity in their house. They were buying second houses. They were buying third houses. They were, improving their lifestyle. So when we went bust in the global financial crisis, it's not like a lot of people were saying, oh, I need more loans. So that was kind of the reason, or one of the reasons, why money didn't get created in our system and start moving around. There was also very little in the way of fiscal stimulus because the Tea Party was alive and well back then. You had China cracking down on some lending, and you also were in the midst of the great globalization, where companies were looking all around the world and they were saying, where can I produce my widgets at the lowest price so I can keep my price down and be competitive? But now we have a little bit of a different scenario. We're rewinding some of those globalization policies. You have the households and the banks in much better shape after delevering over the past 10 years. You have fiscal policy now, and it's coming. More is coming. And you have crossed the Rubicon in terms of extreme policies that have gone on. For example, you have direct money being sent out to people. That's a little bit extreme. But loans, the PPP loans, went through the commercial banking system. They got out there. Why did they get out there? Because the government was backing those loans. Of course, if you're a bank, you're going to send out those loans. The government was backing it, right? You had central banks, the Federal Reserve, buy corporate bonds, buy junk bonds. That broke the rules. And you had the UK print $500 billion for their relief effort and send it out. They did not play by the rules. You're supposed to issue debt. Even if you issue debt as a country and your central banks buy all that debt, you're supposed to go through that process. That didn't happen. They ran the printing press and sent it out. So it is my opinion that in the coming years, we are going to get more monetary stimulus, more fiscal stimulus, and more extreme policy. And if inflation isn't generated soon, likely it will because of that.
Right. Don't we need employment moving up as well? So, possibly a headwind to that would be the high unemployment that we still have because of COVID. That'll probably, hopefully that gets taken care of.
You need everything humming. And how do you get everything humming? Money.
Right. And we're printing a lot of it.
More extremes coming, in my opinion.
Yeah. So, so what do you start doing? What do investors do about all this?
Well, before that, I kind of want to unpack a little bit of this extremeness, because we've done extremes so far in the past year, and I think the risk is of more extremes. So why do I think that? Let's just talk about that real quick, and then we'll get to kind of what do you do about it. The reason why I think more extremes are going to come is because of the income gap, for one. Take a look at the bottom line here, this turquoise dotted line. This is the 90th percentile and below of earners. And this shows that over the past 40 years, those people have not gotten a raise above inflation. That hurts. That hurts a lot, especially when other segments of society have really boosted their income. So there's this income gap that is a strain. There is a wealth gap because those top earners, the top 20% of earners, own nearly all the stocks. That is in the yellow line and the green line there. So not only are you getting more earnings, your also balance sheet looks great because the central banks have reduced interest rates. They've done quantitative easing to prop up asset prices to hopefully make people spend and trickle down to the entire economy. That has benefited the people who own stocks, which happen to be the higher earners. And COVID has made all this worse. This is employment levels, so the number of jobs for high income earners in red, middle income earners in green, in blue, the low income earners. And you can see that the high income earners and the middle income earners, those employment levels are either back to pre-COVID levels or almost back to pre-COVID levels, but not for the low income. That's where the jobs got hurt, and that's where they still have so much work to do. So this has been percolating for 40 years and now has exploded a little bit, and we are seeing this manifest itself in a number of different ways. Most recently, a month ago, I'm sure a lot of people heard about GameStop. That was the millennials taking on the established big hedge funds. That is almost class warfare, but also demographic type of warfare. You had both Nancy Pelosi and Mitch McConnell's house graffitied in the same week. Where's my money? We want everything. This economic divide, is part of the Black Lives Movement. It's part of the storming of the Capitol. Bitcoin has been around for 12 years and is gaining strength. What is Bitcoin? Bitcoin is a store of value outside the traditional system. They call it the people's money. That's gaining strength. The other most popular crypto is Ethereum. Ethereum is trying to replace many parts of the existing financial system. So all this is kind of bubbling up, and this has happened throughout history. What happens throughout history? Governments throw money at this. And so this is kind of the reason why I think extreme policies could be coming, and thus that increases the risk of inflation.
Yeah, well, that was a quick overview of some of the major events that happened in the last 12 months.
That was a fire hose of yes.
Yeah, but man, you're right. Those are really some big extreme things that we're seeing that are coming at us that we have to be dealing with.
Yeah, it's right
All
there.
right,
It's right there.
it is. Yeah, that was a good overview. Thank you. So, all right, now what are we going to do?
What are you
Right,
gonna do?
we're talking about low interest rates. We're talking about the we're talking about some extreme events occurring.
Right.
Now what?
Now what? Okay. So the good thing is if you have 60% of your portfolio in stocks, 70%, and you are diversified, then you have a natural hedge for inflation should that happen and raise interest rates. And if you had a bad experience in bonds in the coming years, you're going to be helped out through natural stock diversification. So this is the chart that we were looking at before, large company stocks, US bonds, and cash. Now I've thrown in two things right there in the middle, small company US stocks and non-US stocks. So you can see in gold that small company stocks and non-US stocks have done much better in higher inflation environments to the tune of 6%. The reason for that is usually with some growth happening as well, and small companies are more levered to that growth. And also, when you're talking about inflation here in the United States, that's usually because the dollar is declining in value. So anytime you are owning investments not in the dollar that are appreciating against the dollar, then that helps your returns. And there is kind of a worry that the dollar might decline in value in the coming years. And the best way I can describe that is with this chart, which shows the blue lines going down, mostly down. That's the deficit. So as the deficit is bigger, these lines go further down because it's a negative. Deficits are a negative. The black line there is the dollar index, and you can see it kind of goes together, right? You look at the 2000, late 90s, 2000, where we were actually running a surplus, not a deficit. And you can see the dollar is very strong there. But most of the time, we're running deficits and the dollar starts to decline. So look at the right there. We have a massive, massive deficit now because of COVID. So if this relationship still exists, this might be a drag on the dollar in the years ahead. And that's where owning other currencies versus the dollar might help. And lastly, if you own value-oriented stocks in your portfolio too, so not just the tech darlings, but the value-oriented stocks, they tend to do better in inflation periods as well, because the value stocks tend to be more energy, more financials, more industrials, more materials, those type of sectors that are more levered to inflation. So luckily, there's at least a normal way to essentially skin a cat.
Yeah, so you're talking about the fact that it's not just U.S. stocks and U.S. bonds to be thinking about. There's other assets to be thinking about. Not just the U.S. large cap technology, which has been on an amazing run for the last 10 years, but there's other assets during an inflationary period, the lower interest rate period we should be thinking about. So why don't you just, kind of peel back the onion there a little bit? Like, what are the other investment options that we think about?
Because the other options need to come into play if you have more bonds. Like, what if you have 40, 50, 60, 70, 80%? I know people who are 100% in bonds. So what do you do then, right? So there are three possible options. One is to do nothing. That's one option, right? If your financial plan works with lower returns, you might feel comfortable enough about your volatility. You feel comfortable with your portfolio. You don't necessarily do anything. You just need to accept some lower returns for a while. Not everybody has that luxury. Not everybody wants to accept low returns. So option number two would be to replace some bonds with stocks. Now, as I showed before, stocks aren't a table pounding buy, especially in the United States, because of how expensive they are. But you got to look over the next 10 or 15 years and you got to say it's going to likely beat bonds. But not everybody wants to take on or can handle that kind of in the stomach, the extra volatility of their portfolio. So the third option is looking outside of stocks and bonds, like you mentioned, and looking towards alternatives, which is more nuanced, and we're going to discuss that.
Yeah. So any particular type of other investment option you want to talk about that, besides the pure U.S. or international equities or U.S., maybe even international bonds? Those are the core that we would typically work with. Now we're having to help people start looking outside that and into other specific options.
Right. So let's almost walk into the pool, and let's start in the shallow end and then kind of get into the deeper end in terms of normalcy or comfortability.
Right.
So as we kind of enter the pool, one option is investing in, instead of a portion of your bonds, investing in other high income asset classes. So these are the interest rates that were being paid last year. They've all come down a little bit in US high yield bonds, emerging market debt, preferred stocks, global real estate. I'll add master limited partnerships to this. I'll add bank loans to this. So there are other asset classes that pay higher income that are kind of half steps up the risk spectrum. So historically, if you look at this, they've tended to do better in returns when interest rates are kind of slowly moving up versus a general stock or bond split. So this is an example of kind of one option. You take some bonds, you invest in a fund. We like to use funds that kind of invest in all these combined with a manager that kind of controls risk. But this is one option. Another option is to sell some bonds, invest in some comfortable stocks that you like, let's say the S&P 500, but have some rules to limit the losses. So I'm not talking about market timing like I'm going to try to read the tea leaves market timing, but rules-based approach. So we like a rules-based trend following approach. For example, if you look at the 200-day moving average, which kind of smooths out the wiggles of the stock market, and if the stock market drops below that 200-day moving average for 5 days in a row, the rule would be to sell and go to cash for that portion of the portfolio. And if it goes above for 5 days in a row, you're back in. Now, there are plenty of different rules that you could make. You could look at it just once at the end of the month and say, is it below or above? If it's below, I'm going to sell the cash. If it's above, I'm going to go in. So historically speaking, you look at all the data and analysis on this, they have been able to, or this type of strategy has been able to generate some decent returns, a little more risk, but it doesn't allow you to go down 20, 30, 40, 50%, which is really what people are worried about if they move from bonds to stocks. Another half step is, especially if you want to keep more in bonds, is to slice off a portion of your portfolio and put it in more impactful hedges to inflation. So I'm expanding out this chart. We've showed it twice before. And if you look at to the right, the most impactful hedges against inflation are real estate and commodities. Look how great those returns have been, historically speaking, when inflation has been high. I will add to this global real estate. I will add to this infrastructure securities. I'll add to this commodity equities like metals and mining. So all of these have a kind of a greater punch for inflation. Now, one part of the commodities market is the precious metals market, so gold. That certainly has been talked a lot over the past 2 years. So gold in your portfolio acts as a hedge against extremes. It can help in inflationary scenarios. It can help in extreme deflationary scenarios. It can help big geopolitical events or unrest, and it helps against extreme policies. So let's talk about World War II, the last time we had this type of debt in our system at these levels. How did we get out of that debt? We got out of that debt because inflation started to pick up and the central banks capped interest rates. Remember back at that chart that I showed at the beginning, the 40s and the 50s, the line was like this, right? Why is that? The central banks capped interest rates there and let inflation go up single digits, high single digits, even double digits in certain years. So that's a negative real rate. If you were to take a 10-year treasury at 2% and you have inflation running at 10%, your interest rate really is -8. And that's the type of scenario, extreme policy, where gold does incredibly well. And you can see that in this chart, where in the gray bars, when they are high, that the real interest rate is high. When the real interest rate is low, then that is, or negative, you see the blue line, that's when gold really starts to erupt. Because that type of policy is stealing wealth. It's stealing wealth. And when you feel like your wealth is being stolen, you want a store of value, and gold has been the store of value for 3,000 years. So those are all half steps, Greg, where you're kind of taking on a little bit more risk, or you're diversifying your portfolio to try to help in the scenario.
Yeah, and so it's not something you put 100% of your portfolio in, because you're really trying to diversify and you're trying to create a little bit more ballast. How about I'm not interested in taking on more volatility? Like you just gave me some great examples of good alternatives, maybe to have a higher yield, a little bit more insurance against market extremes. But if I really don't want volatility, what should I be thinking?
Right. So I'll just quickly say these, and then we'll wrap up and get to question and answers, since we got about 12 minutes left, I see. In order to get a little bit more return with bond-like type of risk, that's a tall order. So you need to look all over the place. And I think you need to look in the private world. For example, private real estate. So private real estate is appealing, with what you're asking me, because private real estate, commercial real estate, is valued by appraisals, similar to your house. It's not valued every second of the day where emotions can throw it around. It's valued by appraisals, comps, or committees that look at the rental rates long term and how they're being impacted, and they're assigning a value to it. And that's attractive to a lot of people. You can see the past 10 years. Along the bottom, the x-axis here is the volatility, so lower on the left, higher on the right, and the y-axis to the left is the return. Look at private real estate, 10% returns over the past 10 years, below 2% volatility, lower volatility than corporate bonds. But more importantly, look to the right where it says the Vanguard Real Estate Index Fund. So that's the REIT index, publicly traded. And because it's publicly traded, it's got huge volatility. So that is the difference. We're going to have a breakout session at 11:30 on private real estate. We're going to be talking to one of our preferred investors, Blackstone. So anybody who's interested in this type of investment but wants to learn about the nuances of being in a private investment, I would recommend going to that. And lastly, I'll say hedge funds. You just got to realize that hedge funds can either be aggressive hedge funds going for high returns, or low volatility, conservative hedge funds. So if you're replacing bonds in your portfolio, you just need to be looking for a conservative hedge fund strategy. And there has been ones, there's a lot of talent out there that have been able to produce some decent returns with bond-like volatility. So those are two options as well. We're going to have that session, that breakout session at 11 in 10 minutes. So if you're interested in that, or the recording or of any of this, that's I'd recommend going to that. And that's it.
Wow.
Piece of cake.
I think we've always learned that the adage that investing is simple, but it's not very easy. Right? So there's only so many assets that we can really look at, but then when you have to really unpack them against all the variables that come in play with interest rates and inflation, government policy, Fed policy, the globalization, working with, where we're manufacturing goods and services, right? Where it's coming from, all these things can be unemployment, and then dealing with the extreme issues that you were talking about. So many different things that come into play to making these decisions. It's not all that easy. And the key that we've always talked about is it's about the individual investor, right? It's about our client. Like, how do you make this work for each client? And it's not, one size fits all. Everyone has their own personality around investing, their own cash flow needs, et cetera, et cetera. Jeff, why don't you just do, if you can, I'll see if there's any questions that we can ask, but why don't you just give a little summary of what you think are the key highlights of what you've just talked about?
Yeah, so similar to what you were just talking about, hopefully we unpacked the issue that we all have to think about now with the low interest rate environment, how it's especially impacting bonds, but impacting all types of other asset classes. So expectations are important. And then we went through all the various options that you may or may not want to use. And what you said there, Greg, was most important. People, I bet, when I was talking about these various options, had different reactions. I bet some people were like, for one thing, oh, yeah, it seems reasonable. Other people were like, no way, not a chance. I'm not doing that. So that's what we see. That's what we know. People are all different. You just need to take a look at your own situation, your own financial plan, your own portfolio, discuss the pros and cons of all these options, and then build in the portfolio that have different roles in the portfolio to accomplish what you're trying to accomplish, protect what you're trying to protect, et cetera.
Yeah, that's helpful. So let me ask you just a couple quick questions. We got a little bit of time left. So here's a friend of mine who chimed in. He says, how does an S&P investment with rules as an alternative to bonds handle a crash that happens over a week? So if you have a 5-day rule, you can have a huge loss in that interval.
Exactly. It does not help. All this has been researched. Trend following, rules based, has been in commodities for a century. But in the 1987 crash, for example, it would have not helped because it's straight down. There's not 5 days in a row. But for example, in the 2008 crash, or not crash, recession, it kind of rolled over, got out, with a slightly negative, only a slightly negative return for 2008, and then it was in cash the entire way down 36% that year. So it is a luck of the draw. That's why you might want to have a couple of different indexes in there following different rules to try to balance it out. But yeah, it is a little bit of a luck of the draw. And it's an example of how all these options have pros and cons. Every single one of them. There is no silver bullet. And you got to talk that out. You got to think those through and then make choices.
Yeah. Don't we have a session on the trend issue on the stocks? When is that session?
We do not have a trend this one or this summit.
Okay.
But we will likely be having future events where we kind of unpack, have breakout sessions more on some of these other ones that I talked about, not just private real estate and hedge funds.
Yeah. It's a good conversation to have, and we'll be having more of those conversations around the trend concept for clients who are looking for more yield, more return over time. But the question is really spot on, that you can get caught in a quick downturn that has quick recovery. Here's another question. Why does increased debt lead to lower growth if the debt is incurred by government spending that is designed to stimulate growth?
Great question, because it's nuanced. So if you were taking on debt and your, for example, debt to GDP is below 90%, that shows historically all around the world for decades and decades that it's helpful. It actually helps growth, helps inflation, higher interest rates in that. The problem is once you get over that 90% of GDP, and this is research done by not only McKinsey, but Carmen Reinhart and Ken Rogoff, economists. Once you get over that 90% debt level, it becomes a drag. It becomes a drag. The interest burden is just too much, and you steal things from other parts of the economy, and it's just tough. I mean, to give you an example, if the interest rate level were to go up by 0.5%, we could no longer fund the Navy. That's the cost of funding the Navy. So interest rates are a big deal when you have a ton of debt. And when you have a ton of debt, that has led to lower growth.
Yeah. All right, here's one of your favorite topics. What is the role of cryptocurrencies in our investment portfolio or investment planning?
Huge thing to unpack. We will likely have an education session on this later this year. We're hoping to have one in a live event, but COVID came. I will just say that it is hugely volatile, huge unknowns. There are definite reasons where you may want to have 1% or 2% of your portfolio in cryptocurrencies. Be completely comfortable about losing every single penny of it, but it is a hedge against a new asset class. It is potential inflation, kind of like gold, what we were talking about, but in that form. It's just another asset class that's becoming more alive, but it's so in its infancy that you never know what can happen to bring it to zero. So I can't really say anything above that because you get it down the rabbit hole that is so unbelievably long and complex that I'm just going to end it there because if anybody on the call wants to talk about it more, call us. We can talk about it.
Yeah. I mean, there's so many unknowns with cryptocurrency still today. It has a really interesting factor, so much so that you're going to see, all government entities eventually moving towards a cryptocurrency of their own store value. And so the question ends up being, I think we're looking at with the Bitcoins and Ethereum and things like that. One of the challenges they obviously are going to have long term is regulation, and how governments can come in and regulate it can change the whole game compared to where they are today. So that'll be interesting.
And if you have a digital dollar, so a dollar that's in digital form, guess what you can do? You no longer need to go through commercial banks to have policy. Boom, boom, boom. You just send it right to the people who you want to send it to stimulate. Again, going back to the extreme policies of how more money can get to more people. There you go.
Yeah. Wow. That's an interesting note to end on. Anyway, we are in a low interest rate environment. We are in an uncertain environment. And I agree with you, Jeff. I think we've got to keep our eye on the extreme policies and how they're going to impact investment portfolios. So with that, I want to close it up. I want to say thank you to everybody. There's another session starting at 11 o'clock that's going to unpack a little bit more specifically to some of the things that we're talking about in a low interest rate environment. How do you invest? And we hope you'll go and enjoy that. And reach out to Jeff, myself, your relationship manager, your team at SBSB, and we're glad that you're here. We hope you enjoyed it, and I wish everybody a great day. Thank you.
Bye-bye.